Alrighty, folks, if you have any money invested in the stock market right now, or if you're planning on investing any money, I think today's video is going to be a very important one. I'm hearing in the caves of the stock market that we are going to have what's called a Ripper rally starting in June. And I'll explain that in just a moment, a Ripper rally. And I want to talk about this from both angles. I want to talk about this, and I'm going to show you a lot of data, charts, things that are very important to look at if you're thinking about the chance we have a Ripper rally, or also that we could go down substantially more from here. And what you're going to find is there's definitely some arguments that can be made on both sides, but there's one argument that ultimately I think wins out in this situation as of right now. And as somebody that's obviously got the majority of my wealth in the stock market, these are things I definitely consider, like, you know, if we're in a vicious bear market, where's the end? Where's the bottom? When do we start going up again? When does the sun come out again? Because for the last number of time, right, it has been nothing but clouds and storms for a while now, right? Tech stocks are basically have their longest losing streak since the dot-com bust, right? The NASDAQ dropped for a seventh straight week, the longest weekly losing streak since 2001 during the dot-com bust, okay? NASDAQ's off 29% from its record back in November. And basically, at one point, this actually Friday, before we kind of had a little short covering at the end of the day, the NASDAQ was down a shocking 31% year to date at one point in that day. That was just incredible, right? 31%. Like, you got to be kidding me. Year to date, we're 5 months into the year. And so this is a historic year we're going through where stocks are just getting absolutely devastated. And you look at invincible stocks, even the most invincible of the invincible stocks, right? Like an Apple is down 24% year to date so far. The invincible Microsoft is down 24.5% year to date. The invincible Tesla is down 44% year to date. We're 5 months into the year. Google McDougal's down 24%, and the invincible Amazing Zon is down almost 37% year to date. We are in a once in a kind market right now where you don't see this almost ever, other than when you're going through serious crashes in the market. And when you start talking about a 30% drop in the NASDAQ in a 5 month span, you're crashing. It's no longer like, oh, this is just a slight correction. You're in a crash. Let's start calling the stock market what it is. It is a crash. When you talk about NASDAQ down 30% in 5 months, that's a crash, okay? Let's be very, very clear about that. There's no in between. That's a crash, okay? And so basically, we got to get into this. Like, let's talk about if we're at the bottom, anywhere close to bottom, things like that, okay? Now, first off here, if you're feeling like we're getting toward a bottomish stage, the good news is large cap valuations have come down immensely. This is where we're trading at right now. Okay. And so this is good news that now we are under like ranges we were in 2016, 2017. That's great news. Okay. It's also great news that we are down massively from these insane numbers there, right? Those numbers that we were at there when we were pushing 22 plus for forward Ps on large caps, you know that's coming to an end, man. You know that's coming to an end. You can only stay up there so long, right? No different than in the tech bubble in 99, 2000, right? You knew that there was only a place to go was down from there, right? And eventually, kind of like the tech bubble, things ended up finally bottoming and starting to come back, right? But we're in this situation here with large caps where, yes, they're down substantially in terms of forward Ps, but at the same time, okay, this is very, very important for everybody watching this to understand. At the same exact time, you cannot say that buying large caps is necessarily what I like to call stealing money, okay? And so there's certain periods that you get into with valuations with stocks where those stocks are so heavily discounted that I call it stealing money, essentially, where those stocks are just so far through the floor that they are beyond easy money. Like, then your returns you're going to get are going to be ridiculous in the coming years. Large caps, I feel like they're a good valuation. I feel like if you're going to buy them, you're going to make money over the next 5 years. But at the same time, and I'm starting to actually buy a little big techs, which is the first time I've started to buy some big techs in actually years, okay? But when I look at these big techs, I'm seeing, okay, some deals are starting to emerge, like Amazon specifically. But at that same exact time, I don't think it's necessarily like shooting fish in a barrel or like a situation where it's like the easiest money to be made. There's other stocks out there that I think are far, far more along those lines. Okay, so large caps could definitely fall more here. Small caps, right? Which I've been buying small caps for months now, months and months, probably almost a year now straight, right? Because small caps have been getting into like more insane great deals. Like if you want to talk about just like overwhelming risk reward over the next 5 years, it's in the small cap space. You know, we're trading so far beneath anywhere we've ever traded out when it comes to forward P's on small caps. The only time period you can compare this to is in the Great Recession. And that's it. That's literally the only time period, well, technically for like 1 week in March of 2020, you could compare it to too. But outside that 1 week in March of 2020 and the Great Recession there's no other time period that you saw small caps in any time in recent history trading at 11.7 forward P ratio for S&P 600 small caps. So if you're looking for somewhere that kind of shows you, my gosh, have we fallen off a cliff? It is small caps. And this is where I see the real opportunity. And in my opinion, what you'll end up seeing with small caps is those will come back first. And those will come back the fastest. Whatever you're going to see in big tech, when big tech starts coming back and whenever that bottoms, you're going to see small caps come back 2x, 3x, 4x. So if, let's say, a big tech and Amazon is up 3% in a day, let's say, for instance, some of these small caps are going to move 6, 9, 12%, just as a way over indexed and moved to the negative side, right? On the flip side, when the market turns, these stocks are going to make moves like you have never, ever seen in your life, unless you've been in the market for a very, 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 very long time. They will make moves like you've never seen. Just as a lot of these small caps have fallen to valuations that a lot of us could not imagine, the moves in the upside will be like you couldn't imagine. And you can only trade down here so long. And so it's just kind of like a ticking time bomb. It's like, when does it move? Is it next week? Is it next month? Is it 6 months? Is it 3 months? Is it 12 months? Like you can only trade down here so long. Kind of like this time period became a ticking time bomb when valuations started to get stretched on small caps and you started to go to 20, 22, 24, 26. You knew, oh boy, okay, this is just a ticking time bomb. This is, we're waiting. This is just, counting the seconds until we just basically drop through the floor. Now we're in the exact opposite situation where you're just counting the seconds until we make some runs that we have not seen before, okay? Now, well, this is kind of like the consensus on Wall Street right now. The consensus on Wall Street is, stock market bottom remains elusive. Things are going to get a lot worse before they get better, this fund manager says. And this is this is like the overall notion coming from Wall Street right now. And there's like 2 time periods when I like to watch CNBC. One is around like January of each year. And the reason being is I like to kind of hear what fund managers are thinking about for the next year. Like, what is the consensus? Do they think it's going to be a good year, a bad year, an okay year? And also the other time period I like to watch is like when we're going through a dramatic down market, right? Look at what we're going through. And what I'm finding right now is these fund managers, no one wants to call a bottom right now. They are scared out of their minds right now, okay? Now, if we go back to the beginning of this year, what I found time and time again, listening to these fund managers and these folks that are Wall Street at the end of the day, is what they would say is they would say, hey man, the first half of 2022 is going to be volatile. Now, when Wall Street uses the term volatile, that basically means down, okay? It means like there's going to be a lot of shaking around, but pretty much what they're saying is it's going to be a lot of shaking around, it's going to go down. Like usually in the highest periods of the VIX, you're going to find the stock market was tanking, okay? So it's just an easier, better way of saying like stocks are going to tank, okay? Now, the notion now is, or the notion back then actually, was that the second half of the year would pick up and things would come back along, okay? Now, the question is, have fund managers kind of shifted? Well, we'll see. We'll got to wait till the second half of the year to really begin to see how these folks are feeling, right? And so As of right now, they're very, very scared. And in order to get Wall Street to start jumping on, I think you've got to see like a confirmed bottom where you come off 5%, 10% from the NASDAQ. I think at that point, some more of these fund managers will start jumping on, Wall Street will start jumping on and be like, okay, we've bottomed now, we can start getting in. And kind of like it becomes like a self-fulfilling prophecy as more and more people flood in, right? All of a sudden you're in the situation, especially if you have very little selling pressure because almost everybody sold that could have wanted to sell. All of a sudden you have nowhere to go but up for the market then. It happens time and time again, right? Now, and if we look at, past bear markets, S&P at one point Friday was down over 20% year to date. So this is a situation with the S&P where, if you look at some of the past crashes, we could have a lot further to fall. And that's kind of the scary part that everybody's looking at here and kind of thinking about. Because if you look at each of these situations, we fell more than that, right? Now, to kind of add insult to injury in this situation is if you look here, and this was part way through Friday. This was like a couple hours before the close, essentially, and we were down 31% on the NASDAQ, around 31% on IWM at that time, and almost 21% on the S&P 500. But essentially, usually how this works is the Dow and the S&P 500 are usually 3 to 5 percentage points kind of better, I guess you can say, than the QQQ in a down market. But the problem is we have this spread of 14 percentage points and 11 percentage points. So essentially what this means is one of two scenarios has to happen here, okay? One is the NASDAQ comes back incredibly strong and gets more in line with these, why these don't really move too much, or the Dow and the S&P have a lot further to fall until they get into somewhat realistic ranges with where the NASDAQ is and the Qs are. And so that's essentially what we're looking at. One of those two situations will play out because as we know throughout history, 3 to 5 percentage points is normal. This is not normal. So unfortunately, for a lot of big companies, the drops could be, quite a bit stronger from here, okay? Now, we're going to get into the bulk of this video now, some very important charts and data I have to show you. But first off, I want to shout out FTX US, the sponsor of today's video. FTX US is the crypto exchange I personally use. They have among the lowest fees out there. They're the most secure and stable place if you're looking to buy Bitcoin, Ethereum, other cryptos, and build out your portfolio. They also make it super easy. They have recurring buys, which essentially if you want to buy, let's say you want to buy $15 of Bitcoin each week, you can set it up through FTX. So they do all the hard work for you. And basically you just automatically buy $15 each week if that's something you want to do. And basically every single time you buy $10 or more of crypto, you actually get every trade over $10 of crypto, you get a free coin, which is pretty darn cool. A free coin's amazing. And not only that, right now, basically when you sign up with my link, that will be pinned comment down there, and you use my referral code, holy smokers, you can get up to $100 in free crypto from FTX US. And also, just very recently here, they just announced they're going to get into stocks. And so I'm going to share a lot more exciting details with you guys coming here in the future about what they're doing in stocks and everything that's going on there. They're partnering with folks like Steph Curry, Jeremy Lefebvre, Tom Brady. I just had to throw my name in there, okay? But in all seriousness, FTX US is absolutely amazing. They're tearing it up. They're changing the game when it comes to crypto, and they're going to likely change the game when it comes to stocks as well. So make sure you sign up, take advantage of that, and get your free crypto, and with you setting up your account and starting to trade through there, and take advantage of that while it's still going on. It's there for a limited time, guys. Alrighty, so look at this. I was going through my Instagram the other night, and I found this post from December 24th, 2018 on my Instagram page. And what I found there is 706 likes. I should have got more likes than that, man. What the heck, Instagram? Okay, but no, in all seriousness, I showed this chart. And so I think there was a day the market bottomed in 2018, or right around the day the market bottomed in 2018. And essentially what you're going to see, okay, is this shows you kind of quarterly performance over time, and then what the performance was 1 year later, 3 years later, 5 years later for the Russell and for the S&P 500. And what you're going to find time and time again is you go through these absolutely incredibly vicious time periods where stocks just get absolutely leveled. But then you look back 1 year later, 3 years later, 5 years later, and it's like, holy smokes, man, there was a lot of money to be made. And the reason charts like that are very, very important to look at is so you understand when you're in one of these down markets where you're getting absolutely shredded and you're buying the dip and it goes lower, and you're buying the dip and it goes lower, and you're buying the dip and it goes lower, right? Time after time again. You got to understand, you're more likely setting yourself up for massive gains as long as you're buying along that dip. And actually, to be fair, every single dip throughout history, was a massive buying opportunity, and especially in recent history. So if you want to go all the way back to the 80s, 90s, 2000s, the 2010s, every single time period, and you are even in the 70s, every single time period, you got a chance to buy stocks for discounted prices. As long as you were buying along that dip, you made out a fortune, okay? And so, when you're going through these time periods, it's very important to understand, they are short-lived, they do end, and the next thing you know, you end up prospering and making a lot of money, but you have to be willing to not only hold through that, but you have to be willing to buy, because that's where you get the most discounted prices you'll ever find, okay? Now, the AI investor sentiment, okay, is in a bad place right now. It's in a bad place. Over half of investors are bearish on the market right now, which bearish basically just means they believe the market's going down, all right? Over half of investors. So we're at this moment in the market right now where folks are still saying to themselves, I don't believe in the market for the next 6 months. I think it's going to be bad. And until we get out of this place, it's hard to get some positive momentum in the market because just such an overwhelming percentage of folks are bearish for the next 6 months. The only good news is, if you want any good news, is we're less bearish than we were back a few weeks ago when it was almost 60% of investors were bearish on the market. But still, at the end of the day, this is a disastrous number. The fact that over half the market is bearish, half of investors are bearish, when usually it's about 30%, it's not good, okay? That's not good at all. And so, the thing you got to understand about sentiment is it can change very quickly over a 3, 6, and especially over a 12-month span. I've seen it time and time again where the market, in a 6-month span, let's just say, for instance, can go from ultra bullish to ultra bearish. And I've seen it vice versa, okay, where you're in a market that's ultra bearish like we're in right now. And next thing you know, 6 months go by and all of a sudden everybody's like an overwhelming population is bullish. And it's like, how did that happen? Like, how did we switch up that fast? It happens all the time in the market. And if you look throughout history, it just consistently happens, okay? And so, if you look at kind of look at the week ending in April, or excuse me, that was for bearish. But if you want to talk about the most bullish week, previously, it was April of 2021. It was like something like, I think 59% of investors were bullish, right? And so then all of a sudden you fast forward to April 27th of 2022, and it's like, almost 60% were bearish. And it's like, that happened in a 12-month span. And so you got to understand the numbers you're seeing in front of you today could be dramatically different. 6 months from now, 12 months from now, heck, even 3 months from now. Sentiment, it takes a little while to change, but in a matter of 2 months in the stock market, 3 months, that's everything, okay? Now, also, this is very important for everybody watching this. Margin debt, which is essentially people investing with money they don't really have, okay? Investing debt money through a brokerage. That number is starting to come down. Basically, we peaked in October, right exactly basically when the markets were peaking. I think beginning of November, that first week in November, markets all peaked. And we peaked at over $935 billion of margin debt. Now, fast forward, we're at 772. I think when the May numbers come in, we're going to be at somewhere 700, maybe 650. And the reason being is a lot of people like to margin into big tech. And if you look at big tech in the past month, it's been bad. A lot of people love to margin into a stock like Tesla, right? And because, Tesla's like it was $1 trillion market cap, and people are like, oh, it's going to 10 trillion, it's going to 5 trillion, whatever, right? And so people like to margin into that. Well, dude, with Apple, Google, Microsoft, Amazon, Tesla, Nvidia, all those stocks getting absolutely wrecked, specifically the past month, I can almost guarantee you the margin number is going to come down considerably, and we're going to probably be at the lowest levels we've been at since around November of 2020, all right? That's how far we're going to drop here. And so when you look at the May numbers, wait for those to come out. They're still going to be out for at least 3 to 4 weeks from now. But don't be surprised at all if you see a $700 billion or $650 billion type number there. Trust me, man, people are dropping margin left and right. And one of the other big reasons is not just because people are so scared right now, so they're like, I got to sell off my margin, but also for the mere fact that interest rates are going up. When interest rates go up, right, margin interest goes up. So the more the Fed's going to continue to raise rates, we'll see how long they actually raise rates for, but the more they do that, the more it hurts investors who invest on margin or trade on margin, because now you have to pay even more margin interest, okay? This is something very important to keep in mind that not even a lot of people think about, okay? Now, here's the deal. we got a lot more bad economic news coming. All right. So for instance, U.S. Atlantic put this out. The U.S. housing market's peaked. I 100% agree. And I've been saying for the last few months, I expect the housing to slow substantially in the summer. And I think prices are going to come down massively. I think the buyers are going to dry up. I think it's already starting to play out. If I look at local markets that I own properties in, if I look at data from basically all over the United States, that's not backwards looking data, but more the data that's kind of more current, I guess you can say. If I talk with folks that have been in this industry for a long time, it's bad. And it's getting bad so much faster than even folks that are, I guess you could say, real estate kind of bears in the short term. It's getting even worse than a lot of us expect it, right? A lot faster. And so unfortunately, a lot of the real estate numbers you might look at are going to be backwards looking. So they're going to look at like a month ago, 2 months ago, things like that. But I'm telling you, real time, it's ugly. And it's going to get ugly really fast. And just wait for, the next quarter, the home builders report, when they are going to tell you basically the orders aren't coming in. They're not even coming in remotely close to the way they were coming in a year prior to that. Just wait till that next quarter, which those numbers will be reported in late summertime, okay? Maybe like August, somewhere around there, August, September. You want to talk about home builders telling you some bad information? Oh boy, that's going to be the time, okay? When it comes to new orders and everything like that. And so we're at this moment where how's the stock market going to react when housing prices just come down and come down and come down and real estate comes down? We don't know how that's going to react, right? But it's not a good thing. And, I put out a video back in January that I was preparing for a recession, right? Now, here's the deal. I don't think a lot of people prepared for recession back in January. So I think it's recent. All of a sudden, all these people are looking at it and they're like, oh, maybe I should cut down on margin debt. Maybe I should cash up a little bit. Maybe I should do this, do that. And the problem is it starts to kind of lead to this panic, especially if you're already in that recession, which is there's a strong probability we might already be in technically like a recession. We just don't necessarily realize it yet, right? Where things get even worse with inflation, everything that's going on. And so that leads people to panic sell different things. That can be crypto, right? They panic sell at prices because they're like, I got to cash up. I got to prepare for recession. They panic sell stocks because like, oh crap, recession's coming. I got to, I got to try to get ready for this. Real estate, I'm looking at price cuts. Whew. And here's the thing. I think it's just the start of the price cuts. I think the real price cuts are coming this summer when people are just going to cut. New listings are going to come to market. They're substantially undercutting the previous listings, and those ones still might not move. And then the next group kind of undercuts them, and those still don't move. And people are like, what the heck is going on here, man? And so it happens fast because a lot of people just weren't prepared for a recession. All of a sudden, they're like, shoot. This is the thing's actually going to happen, right? And how's the market going to react when massive layoffs start coming, which I think is going to start coming? We're already hearing about some of these companies over the last month or two laying off employees, but I don't think we're even that close to peak right now. I think we're still in kind of like the first or second inning of layoffs. I don't know if we're going to get as bad as it was in the kind of 2008. 2009 situation when it comes to layoffs, but I think there's going to be a lot of layoffs coming. And so how does the market react to that, to people losing jobs? Got to understand, when people start losing jobs, there's a much higher probability that rents won't be paid, mortgages won't be repaid, credit cards won't be repaid, loans won't be repaid, which means you got all of a sudden bad debt, right? Which that kind of leads itself into a bunch of bad dominoes. And unlike 2020, when you had the government bailing out everything and saying, hey, we're going to pay your rent for you, we're going to pay your mortgage for you, you don't have to pay your student loans, you don't have to do this, you don't have to do that. When all that's already ended, right? And so that just kind of leads you in a situation where there's no helping hand necessarily for that. And that's where it just gets, I guess you can kind of say, extra kind of ugly. And so how does the market react to when unemployment starts climbing? Because that's when everybody starts to realize, oh gosh, yeah, the recession is here, okay? Now, you look at something like this. The venture capital market the money's drying up, and it's drying up fast, okay? And everybody I speak to that's in this industry, money's drying up. Rounds aren't quite being met the way they were met in the past. And even, VC firms that might have good returns, they're not hitting numbers. They're not pulling in that money. And so VC money is drying up left and right. And the problem with VC money drying up left and right is there's so many of these Silicon Valley companies and companies in general are funded through VC. They don't make any profits. They don't make any money. And so if it's not for the VC money, they're going to be out of money quick. That's the thing. It's going to happen quick. Like, and some of these companies burn so much money that in 3 or 6 months, they're not going to have a company anymore. And they're going to have to, that workforce of 100 employees they had, they got zero now because they didn't make it, or they had to sell out to another company or something like that. Like, it could get messy really, really fast. And that's a whole scary situation in itself. And then VC money starts to panic even more and more and more, right? And then all of a sudden VC goes from like this glorious thing where, oh, you can make so much money investing in VC, to all of a sudden it's like, look at, they just lost money. They just lost money. They just lost money. They just lost money. And all of a sudden it becomes like some big dominoes start to fall. That gets ugly really, really quickly. So kind of like the water's drying up in Lake Mead, man, that VC money's drying up fast. And I'm telling you, if you want to think about layoffs, job losses, and just overall more economic worries, this is where you're going to see that from, okay? Now, the important thing to remember about all this, and although there's a lot of things to be scared of right now, the important thing to remember here, folks, is, the stock market bottomed around February 2009 and started coming back with a vengeance. And meanwhile, we still had devastating economic information and news coming for months. Actually, no, years. Real estate didn't bottom for like another 2.5 years after the stock market bottomed. Layoffs kept coming. Job losses kept coming. Food stamps, the amount of people on food stamps skyrocketed over the coming years. So the stock market can bottom way before you get a bottom in the economy. Way before you get a bottom in anything else. And so this is what is very important, no different than the stock market's already been getting killed while everybody's looking at the economy and the economic numbers and like, man, everything looks good. What's going on with the stock market? It's falling like crazy, right? And so these are the important things to remember and think about in a situation like this, right? And especially with inflation going on, right? And I think the rate of increase of inflation is going to come down massively as the year kind of progresses here. But even as the numbers decline in terms of the rate of growth, it's still inflation. And it's still, even if it's 5%, it's like, yay, it's 5%. It's down from 8.5%. But it's still 5%. That's still a pretty big number, right? And even when it drops to 4%, 4% is still a pretty big number. We can't start to get comfortable in the market till get closer to 3%, right? And that's, especially once we get under 5, that's when the Fed can start considering kind of dialing back everything they're doing. But under 4 is when they can really start to dial that back and start to say, hey, you know what? We might chill on interest rates for now and things like that, right? And if you look back at the 2020 crash, same exact situation. The market bottomed in March of 2020, right? We still had so much bad news. We still had so many layoffs that were coming. The unemployment rate kept skyrocketing during that time. Companies' earnings were horrible during this time. Rona certainly wasn't over. Rona was just getting started, right? And so we still had so much bad news, and yet the stock market was going up and up and up. And so this is something to remember, that the stock market will bottom way before bad news bottoms, okay? And this is something important to kind of keep in mind. And so that's why with me for this year, it's hard. It's such a hard market to try to say this is the bottom, this week's the bottom, because I look at it and I'm like, dang, man, I think a lot of these stocks are massively oversold. But with that being said, I do understand that there's going to be a lot of bad news coming in the economy over the next 6 months. And the story's likely going to get worse for the next 6 months, if not the next 12 months. And so at some point we will bottom, and we're likely bottoming at some point in 22. But with that being said, it's very scary to try to even stick your head out there and call a bottom right now, just for the mere fact that I'm looking at this and I'm like, there's still a lot of bad news coming. Real estate's going to start to tank. They're going to start reporting on that. That's going to start hitting the headlines. Fed's not going to reverse for at least probably another 3 months at the earliest, but probably you're looking more at 6 months for the Fed maybe changing kind of what they're doing. Unemployment's going to start rising. Massive jobs are going to start being lost, in my opinion. Construction jobs are going to start drying up at the end of 22, and especially as you go into 23. And so I'm looking at all this, I'm like, dang, man, we got some bad news coming. But like I said, you can always get a bottom way before the economy bottoms or bad news bottoms. So that's why when I look at this year, I'm like, dude, I just got to stay focused on buying. And at some point we're going to bottom. I just don't know when that is. It's a very confusing environment to try to say this is a bottom. That's why you also don't see me buying any call options. I'm buying stocks straight up, and that's it. I'm not buying call options. I'm not even buying put options. I'm not doing any of that right now. I'm just looking at this practically. I'm like, I think this stock's significantly discounted from where the stock's going to be trading at 5 years from now. I think this stock is. And so I just buy these stocks. I got 10, 20 stocks I'm buying right now actively. I'm putting money in those stocks. I'm just going to continue to put money in those stocks as I see fit. And then everything else is just going to kind of play out there, and we'll kind of see what transpires. I think you have some good arguments that could be made on both sides, but I think we definitely have a lot of bad news coming. And I think that's going to start to hit the wires over the next 6 months. And, that will create kind of a lot of fear out there in the market in general. So hope you guys enjoy this as always. Make sure you get from FTX US your $100 up to $100 in free crypto down there, guys. That's absolutely amazing. When you deposit through the platform and trade through the platform, you get free crypto. Also with trades over $10, you get free crypto. Use my referral code HOLYSMOKAS. Sign up with that pinned comment. That's a limited time offer there. So definitely take advantage of that. Much love and have a great day.